Very much. Everyone, we'd like to get started. Welcome and thank you for joining us today, both those of you who have joined in person and also those of you who have joined online via WebEx. Today, we're very, very happy to present single-family rentals. How do institutional participants view the market and what data supports their views? We have three distinguished speakers: Sandeep Borja, who's the head of research and analytics at Amherst Capital Management; Doug Bent, who's the Senior Manager, Research and Product Development at Investability. And Investability produces Rent Range, which is a sister company that's the source of rental data, which is used by the single-family industry. And Calvin Schnurr, who's a Senior Vice President of Research and Economic Analysis at NAREIT. So today's agenda is as follows. Sandeep is going to talk about the changes in the institutional single-family rental industry over the past year as the industry continues to develop. Then Doug is going to present on the data and data sources for looking at rental information, as well as the structure of the industry. Finally, Calvin is going to touch on the demographics behind the growth of the single-family rental sector, present some information on REIT operators, which constitute about 3/4 of the institutional participants. And then he'll finish up with his views for the future. After that, we'll have all three of the panelists come up, and we'll transition to Q&A, which I'll moderate, and we'll take your questions. We'll conclude this discussion at 2 o'clock. Webinar guests can also participate in the question and answer session. Please submit your questions to events@urban.org. That is events@urban.org. So please feel free to type in your questions during the presentation. Identify your name and company when you send the emails. So with that, I'm going to have Sandeep start, and then we're just going to roll all the way through. So when Sandeep finishes, Doug will go up. When Doug finishes, Calvin will go up. Thank you very much, and I turn it over to Sandeep.
Thank you, Laurie, and good afternoon, everyone. I'm Sandeep. I run research and analytics at Amherst Capital. We are a US-based real estate investment specialist looking at every aspect and every sector in the real estate space. In terms of the agenda today, I'll try to cover a couple of things. I'll start with looking at what institutions in the single-family rental space have been doing in the last 1 year versus what they were doing in the prior 4 to 5 years. In that, I'll touch upon what are they buying, where are they buying, and in general look at the changes in their behavior. From there, I'll go on to make the case that valuations in the single-family rental space still continue to look attractive. And finally, I'll spend a fair amount of time on the different financing options that are available to single-family rental operators and what exactly that means for the sector going forward. So if you start on this particular slide, what I'm showing a bunch of numbers here, but what we can figure out from the transaction history data is that institutions own more than 200,000 homes today. And this is really trying to figure out what they own by tagging the buyer name in some of the transaction history data, which essentially means that the 200,000 number is really a lower bound. There is no way, whatever methodology that we are using, we will be able to capture each and every transaction that is out there. Now, this $200,000 number is interesting for several reasons. Number one, when you look at the average landing cost of each of these homes for different institutions, you get to a number around $33 to $35 billion. And it's amazing when you look at an industry which was not even around 5 to 6 years back, and to get to a point 6 years from then when institutions have already invested close to $35 billion, I think it is pretty amazing in itself. But then when you compare that exact same number to the value of the total housing stock in the US, which we think is close to $35 trillion, you suddenly realize that single-family rental institutions own only about 0.1% of the housing stock in the country. Even if you look at all the single-family rentals outstanding, the share of institutions is less than 2%. And just to give you some contrast, if you look at multifamily, for example, more than 55% of multifamily is owned by institutions. So really, I think, on the single family side, we don't even need to go from 1.5% to 50%. Even if we go from 1.5% to 5%, you're talking about another 500,000 homes coming under the fold of institutions. Now, in terms of who exactly is buying, I'm sure most of you have heard of all the bigger names, American Homes for Rent, Invitation Homes. But what we have seen in the last 1 to 1.5 years is that the mid-sized institutions, the newer entrants, they are the ones who are taking up the lion's share of the single-family rental market. What I'm showing here is the number of homes that were bought by different institutions in each year, starting from 2011. And the color coding, I think, really is to simplify the data. So anytime you see a red or a pink label, that essentially means that that particular institution bought fewer homes in that year versus the prior year. So the top entry, for example, here is Blackstone. Last year, we were able to tag close to 1,200 homes that they bought based on the data that we see, which was lower than what they bought in 2015, which was around 3,000 something, which was again lower than what they bought in 2014, which was close to 7,000 homes. So pretty much all the big institutions, if you look at the top 3 institutions here, they've all been buying fewer and fewer homes every single year versus the prior year for the past several years in a row. The top 3 guys had almost 50 to 75% market share among institutions till about 2014, and that number has gone down to about little less than 20%. In terms of who exactly is getting market share, it's the mid-sized players, as I said, some of the guys like Main Street Renewal, which is an Amherst affiliate. You have Altisource, and to some extent Progress. Some of these guys have been buying a lot more homes. The next slide shows exactly the same data, but I'm looking at percentages here, which makes it a little bit easier. So as I said, if you look at Altisource, Main Street Renewal, some of these guys, the mid-sized guys, they're almost 40 to 50% of the institution market in 2016, and the top players are only about 15 to 20% versus about 60% for as an average for the year 2012 to 2014. Now, you could ask that, again, yes, it's definitely clear that the mid-sized institutions are the ones which are really growing, but it's not to say that the larger institutions are not growing. There is a ton of consolidation activity that is happening in the marketplace. I'm sure most of you are aware that Invitation Homes and Colony, they are going to merge into a single entity. That entity is going to own close to 82,000 homes. And it's pretty striking, again, as I said, we are only in the 5th or 6th year of inception in this particular industry. They are going to own 82,000 homes. And again, to give you some context, on the multifamily side, where institutions have been involved in the marketplace for a very, very long time, the largest operator on the multifamily side in the US manages less than 200,000 homes. So really, I think once this merger is done, the largest entity on the single family rental side is going to own almost 40 to 50% of the homes that some of the largest multifamily operators own and manage, which again I think is very, very, very striking in my opinion. There were a couple of other transactions that were of note. Silver Bay and Tricon, they merged as well, and then there are some other transactions with 1,000 properties, 3,000, 4,000 properties. And again, this is something that we expect to continue to happen over the foreseeable future, because there is still a lot of economies of scale that can be gained. This industry is relatively new, and as people figure out better and better ways of doing things, I would not be surprised if we see even more consolidation, especially when you look at some of the smaller players in the market. Now, when you look at all the different players in the market, obviously, as I said, it's a $35 trillion market. We have more than 15 million single-family rentals. So it's certainly possible to have a wide variety of strategies, and not just wide variety of strategies, but many of those can be very successful as well, because the market is really, really big. But at the risk of oversimplifying, what I've done on this particular slide is taken all the largest operators in the single family space and try to categorize their strategies in 3 distinct buckets. So if you look at the extreme right corner, the top corner, that's most of the publics, whether you look at Blackstone or Colony Starwood. And these guys, most of the public guys, as well as Progress, they have really focused on some of the larger end homes, bigger, newer homes, which generally trade on a slightly lower cap rate. But the potential for home price appreciation, the potential for prices to go up when the retail market comes back and really has a bid for some of these homes is definitely higher than where other institutions are focusing. If you move to the extreme left, the bottom corner where you see Connerex, Cerberus, some of these guys, they're focusing on higher yielding assets, which are in some instances homes which are less than $100,000. The gross yield is very high, but arguably the credit, the tenant that is living in those homes is also weaker quality. There is not a very strong expectation of home prices to go up, but at the same time, the running return is very high. And then finally, I think, for lack of a better word, there are some other players in the middle which I would categorize as value players. They are generally somewhere in the middle versus the 2 other strategies. And I would argue this is really the sweet spot of the single family rental market, in my opinion, because number one, the cap rates are generally much more attractive than where the publics have been operating in. And at the same time, there is tremendous potential for home prices to go up as and when you really see retail market come back over the next several years. The other interesting way that we sometimes look at when we try to understand the strategy of different institutions is to plot them on some sort of a value versus growth metrics. Again, I think a lot of numbers on this particular chart. I'll simplify. On the x-axis, you have the annualized population growth over the past 5 to 6 years. So essentially anything which is on the right, you're looking at an area which has grown tremendously over the past 5 to 6 years. And when you look at the y-axis, it's again job growth. So essentially, the simplest way to understand this chart is if you look at anything which is the top right corner, those are the areas which grew very rapidly, both in terms of population as well as job growth. And that is exactly the type of, those are exactly the type of areas where some of the publics decided to focus on. There's also a small number, and I apologize if it's not visible, but there is also a small number next to every region that is out there. And that is the average cap rate we think institutions have bought homes in each of these particular areas. So when you go all the way to the right top corner where publics are concentrated in, what you generally find is that cap rates are relatively lower than what you would see at the bottom end of the chart. So really, I think the publics have been focusing on more growth, and they're essentially, I think, paying up for the growth in the sense that they are buying homes at somewhat lower cap rate. If you look at the players in the middle segment, players like Main Street Renewal, Altisource, they are buying homes at slightly higher cap rates. So the publics are buying somewhere in the 4.5% to 5% cap rate on average based on the data that we see. Most of the mid-sized players are buying in a cap rate range closer to 5.5%. And the reason I think we believe that is a better place to be in is because if you're buying a home at 4.5% cap rate versus 5.5% cap rate, you're essentially buying exactly the same cash flow, but at a 20% discount. So again, yes, there is likely going to be more growth in the larger segment, but to the extent that you are looking at overall returns, I still strongly believe that the mid-size segment is going to do reasonably well. And finally, I think in terms of what institutions have been doing, just to look at the geographies that they were really active in when they started out in 2010 till almost 2015, and where exactly they were in 2016. So the left-hand panel is a dot plot of the regions that institutions were actively buying in 2010 to 2015. The size of the bubble is the relative proportion of homes that they were buying back in those 5 years. And then we have exactly the same chart for 2016 on the right-hand panel. And the real difference you see is in some parts of California and Nevada, where there were a lot of purchases between 2010 and 2015. And for the most part, institutions have walked away from that region. The largest area, of course, I think if you look at the biggest bubble in both the charts, it remains Atlanta. It was one of the favorites for institutions from 2010 to 2015, and it continued to be a favorite in 2016 as well. This is, again, I think showing exactly the same data as we had on the previous slide. There are no numbers, just to give you a little bit more flavor of what is happening. On the left-hand side, again, data for 2010 to 2015. The top 10 MSAs, so Atlanta was around 15% between 2010 to 2015. In terms of institution share, Phoenix was around 7%, so on and so forth. And then on the right-hand side, I'm showing the top 10 areas based on 2016 purchases. And again, mind you, the list is not exactly the same, so you can't really compare the third name on this list versus the third name on the other side. But the point to note is if you look at Atlanta, which is marked by a flat yellow arrow on the right-hand side, the share of Atlanta in institutional purchases has remained unchanged last year versus some of the prior years. But then when you look at areas like Dallas, Charlotte, Indianapolis, a lot of these areas, the share of institutional purchases has actually gone up in 2016 versus what we saw in the prior years. And finally, obviously, there are some areas, as I mentioned earlier, in California and Nevada that have fallen out of favor. A prime example is Phoenix, which was number 2 between 2010 and 2015, and now does not even find a place in the top 10 purchases in 2016. With that, I think let me shift gears a little bit and talk about valuations. I think the primary concern that people have is that home prices have grown a lot in the last several years. Depending on which index you're looking at, you're probably looking at anywhere around 35% growth in home prices over the last 5 years. Rents have been growing reasonably rapidly, and it's fair for people to be concerned if the trade is really done or if there is more room to grow. Now again, as I said, it's a very large market, very disparate. It's very hard to generalize things. So what I did on this particular slide is something very simple. We started with all the publicly traded companies, Invitation Homes, American Homes for Rent, Colony, and Silver Bay, till they were a separate entity. And what we did is we tried to impute the value of the real estate. So we did some adjustments to whatever was being reported in their Qs, and we came up with a value, the best value that we could for all the real estate that they owned. Then we used that real estate value in conjunction with the reported NOI, and we realized that NOI is not a GAAP measure, but for the most part it's a very standardized measure. And if you look at that NOI and compare it to the value of the real estate that we could glean from the quarterly statements, then we could compute a cap rate. And based on what we could see, our belief is that most of these publicly traded REITs are trading at an implied cap rate of somewhere in the low 5s, somewhere between 5 and 5.3%. Which, given I think where everything else is in the marketplace, I think is very attractive. These yields are nothing to scoff at, especially for an asset which is most likely going to continue to appreciate at 2 to 3% per annum for the foreseeable future. And then, as I said, and I showed some numbers earlier, if you look at the mid-sized players, they are clearly buying homes which are even higher cap rate than some of these publics, which essentially means the publics are trading at around 5% cap rate. They're probably able to buy homes at 5.5% cap rate. And finally, as I mentioned earlier, this is still an industry which is relatively new. People are going to try and figure out more and more ways of optimizing things and running things efficiently, which essentially means that this 5 or 5.3% cap rate that I'm showing, prospectively it is going to look very different because companies and institutions are going to manage things differently. So cap rates are going to look even better, even if you have exactly the same rent growth here versus multifamily. So overall, I think from a valuation standpoint, I think things are very attractive. Demographics, really, I think positive over the past 5 to 10 years. We have seen a lot of demand on the rental side. I think this has been very widely talked about, so I'll not spend much time on it. but pretty much all of the growth in households in the last 10 years has come in form of renters. I think Laurie has done some tremendous work on this, and there are a lot of structural reasons why this is something that we continue to expect going forward as well. But something that I feel a lot of industry participants miss is that yes, rental demand has been very strong, and it has really been strong partly because multifamily has done very well in the last several years. But I think it is important to make a distinction between what is happening in the single family market versus multifamily. And I'll do it with the help of these two charts here. On the left-hand chart, I'm showing multifamily starts over the past 40 to 50 years and single family starts. So the top line, the dark blue line, is multifamily starts, and the bottom line is multifamily starts, and the top line, the darker line, is single family starts. And the key takeaway from this particular chart is when you look at multifamily starts, in the last couple of years, the bottom line, it has been running about 5 to 10% higher than the average that we saw in 2001 to 2006. So relatively speaking, versus where we were 5, 10, 15 years back, multifamily construction has almost made its way back. And partly I think it is really a function of the availability of financing in the multifamily space, which was really available even post 2009. And that was not exactly the case on the single family side. And when you look at the single family starts, they're still languishing 40 to 50% below the averages from early 2000s. So the key takeaway from the left-hand panel here is that relatively speaking, we have seen fewer single family starts than multifamily in the last 5 to 7 years. And when you take that lower supply on the single family side and transpose on the age distribution of the US population, you get something really interesting. So what I'm showing on the right hand side is the US age distribution of the population distribution as of 2013. So if you look at the two biggest buckets, which are between the ages of 20 and 29, you're really looking at those ages as 24 to 33 right now, which is right around the age when people start getting married, have families, have kids, and their need for space goes up dramatically. And the reason I say the need for space goes up dramatically is because what we see on the left-hand panel here. On the x-axis, you have the age of the householder, and on the y-axis, you have the average number of bedrooms. And as you can see that as people go from their mid-20s to late 20s and early 30s, that demand for space starts to go up fairly dramatically, and that's exactly where the biggest part of the US population is sitting right now. The problem is we had all of this supply on the multifamily side. Relatively speaking, we had a lot more supply on the multifamily side, but multifamily, as I show on the right-hand side, about 85 to 90% of multifamily is either studios, 1 bedrooms, or 2 bedrooms. And in other words, what I'm trying to say here is that all the construction that we did on the multifamily side, and again, don't get me wrong, I think it's going to do reasonably well, but relatively speaking, it is not really a great fit for the kind of housing demand that we are likely to see over the next 5 to 10 years. And that again, I think makes us even more positive on single family rentals. Away from that, I'll skip this slide. I think this is just looking at all kinds of broad data on the housing side. I think things continue to look positive. Overall, I think if you look at cap rates, 7.5 to 5.5% range, continued expectation of at least 2 to 3% home price appreciation, probably even more if you're in the right areas, which should get you to about 8 to 8.5%, 8 to 8.5% unlevered return. So then the question is, if you can get to 8 to 8.5% unlevered return, what is the levered return that you can really expect in the market? And it's really a function of the kind of financing that is available in the market. The big development this particular year was the first loan of its kind from Fannie Mae. It was almost $1 billion loan that was made to Invitation Homes. I'll not go into the details, but about a 56 to 57 effective LTV loan made at swaps plus 200. And it is a pretty big deal because Fannie Mae and Freddie Mac were both making loans to homes which were being bought by owners or investors one at a time, and they were doing loans backed by multifamily properties, but this was one market where they were really absent. And again, I think it's not clear if it is going to become programmatic, but we have heard that Freddie Mac is going to do something similar to Fannie Mae, maybe focus a little bit more on affordability. But if that program becomes a mainstream program, it is going to increase one more avenue of financing for the single family rental operators. Obviously, I think the one other thing which was in the news a lot is that one of the largest single-family REIT today also has an IG rating, which essentially means that they will also be able to access the unsecured market, the corporate market, at relatively attractive rates. And finally, I think the traditional sources of financing, the warehouse financing, and private label securitization, I think they continue to be active in the marketplace. Till date, we have seen close to 30 securitizations, and I'll not go into the details here, but just to give you some very quick numbers, if you look at the bottom panel, I'm showing the financing that is available in the securitized market right now at different tranche levels. So if you look at the top tranche, the A tranche, which is AAA rated, you can finance it at around swaps plus 80 basis points, which essentially means you can finance the top 40% at L plus 80. And then if you look at the second column from the right-hand side, that's the cumulative financing spread. And if you were to sell the top 65%, so if you look at the LTV against it, it's about 65%. If you sell everything from A tranche to E tranche, your cumulative financing cost is only swaps plus 115 basis points. You take care of all the costs, securitization fees, so on and so forth. Your financing cost is only going to be around swaps plus 165, which is really, really attractive in my opinion. This is showing exactly the same data, but over time and versus a lot of different securitizations. Again, I think I'm running out of time, so I'll be quick here. The two key takeaways on this slide is if you look at the second row, I'm showing numbers for the Progress 2016 SFR2 deal. And then if you look at the fourth row, I'm showing exactly the same numbers for the same issuer for a deal that they did in 2017. And the takeaway when comparing these two particular columns is that the average financing rate improved dramatically between 2016 and 2017, and even more than what we saw for other securitized sectors. So yes, everything tightened, but relatively speaking, we saw much bigger improvement in financing rates for single-family rentals. And if anything, if you compare it to some of the multi-family transactions, both single asset, single borrower deals, or even Fannie Mae and Freddie Mac, this financing rate is much more comparable to that. So overall, I think just to conclude, we believe that demographics for the single-family rental market are very positive. Demand is going to remain relatively strong. Rental growth has slowed down, but we continue to expect rents to grow at around 3% annum going forward. Based on our models, we believe that home prices are still below their fundamental value, and things continue to look good on that particular front as well. And when you look at this whole complete setup of cheaper homes, attractive demographics, and a lot less construction in the single-family space, I'm very positive that single-family rental market is going to do reasonably well over the foreseeable future. And with the same token, I also believe that institutions will continue to grow. And the institutions that will do really well will be the ones that look at the right asset, are in the right locations, and are also very, very properly aligned with their property acquisition and tenant management platform. So with that, I'll stop with my prepared remarks, and thank you.
Thank you very much, Sandeep. I just wanted to make two very quick comments. First, I know a couple of the slides were hard to read. Those slides are all available on our Urban website, so please feel free to pull them down afterwards. And second, to the extent there are any reporters in the room, you're free to quote, but please just check the quotes with the speakers before you use them. So here's Doug.
Hello? Okay. I thought Haley said this is going to be the operative, but I guess not. So I just have one more disclaimer, since I work for a public company, that the views, anything I say today are my own views and not those of Investability, which is a subsidiary of Altisource Portfolio Solutions. So that gets taken care of. So Lori had wanted me to spend a little time first about talking about some of the data that's available at a granular level. Sandeep talked at a pretty high level of financing and focusing on what some of the largest companies are doing. So I'm going to take a little deeper dive into where some of the data comes from on a granular level and what some of the smaller markets and smaller operators are doing. So Sam Cater here is here from CoreLogic, and they're one of the premier providers of home price and real estate data in the country, along with a couple others. And there's virtually 100% coverage of home price data due to the fact that governments get involved when deeds get transferred, mortgages get recorded, very deep and well-known and well-trusted data. There's no such governmental activity going on the rental side. Most cases throughout the country, landlords are not required to register leases with any government agency. Very few areas do they have pay sales tax, so a few areas do collect rents information with respect to that. Basically, any data that exists on rents is coming from private sources. One private source is the multiple listing service, which again is pretty, not universal, but very widely used on, home sales. Estimates somewhere around 80% of home transactions go through multiple listing services. But on rents, it's much less common for rental properties to go through MLS. It's a tough number to get because most, even governmental sources, don't even track how many houses or apartments are rented each year. So I've just put an estimate there of maybe 10% of the rental properties go through the MLS each year. So in terms of where you can get some data, there's trade associations that also publish a lot of data, some of them which might be in the room here today. The National Association of Realtors, the National Association of Home Builders have put out some pretty good data independently. With the rental side, there is a National Apartment Association that does a annual survey, only annual, no monthly data. And the Rental Home Council, which is a fairly new trade organization, doesn't publish any data yet on the industry on operating metrics. Rating agencies have been a good source of filling in the holes. Kroll and Morningstar do a pretty good job of compiling a lot of data. But as Sandeep mentioned in some of his slides, that's only on the portion of the universe that's securitized, which tend to be only these top 5 or 6 lenders who have done frequent securitizations. So most of the industry, no data on it. And finally, the census does provide some data, but it's very low sampling rates, 200,000 homes throughout the whole country. That's not a very big sample when you think how much real estate there is in rental properties. So Investability collects some of that data also. We license data from CoreLogic, for example, on the property side for housing. We do get some MLS data, so we get as much as we can, but we really have to go looking for data in other places. I'm sure there's probably a song I could have made a joke about if I thought about it. I think it's Looking for Love in All the Wrong Places, something like that. So hopefully we're looking in the right places, but so beyond the MLS, which is a starting point, we look for data in a lot of private places, and some of these are listing sites that are on the web that list apartments and houses for rent, aimed at tenants, and have a lot of data available. We also deal with have contracts with several of the large property management firms who represent a lot of different landlords and do aggregation and provide data to us, as well as directly with some large landlords, including some of the publics. But even with what Sandeep mentioned, 200,000 homes rented by the institutional players at a turnover rate of about 30% is about their average right now. That's 60,000 homes a year that are going to turn over and get a new tenant. That's 5,000 a month. That's not a high number of listings. So you can see why we have to supplement our data with wherever we can from other sources. But we do that. The founder of our company had the foresight to start collecting this data from all these sources back as far as 2009. That was the original rent range company, and the original product was even predated having an automated valuation model. We literally looked at the range of rents by house size in a zip code or counties and would report on that range, and that's kind of where the name of the company came, and then it evolved into getting more analytic tools that are more detailed. So from all this, the raw data we collect, we have a whole list of derived products we do. And the first one I mentioned is our rental estimation model. We had this first rough version in 2009. We're on the fourth generation now, and it pretty much follows the approach of doing a price AVM, looking at comparable properties in the neighborhood, what their listing rents are, adjusting for characteristics and location, and estimating what the monthly rent would be. And that's a pretty robust model. In our testing we've done, we typically are able to value about 95% of the properties, and we're getting accuracy results that are approaching, I'd say, the average to slightly above average price AVM. We're not at the best levels of accuracy that the best price AVMs are achieving yet, but it's continue to work on getting more data and better technology. So and those comp sets are driven off this database we've collected over the last 9 years for rental transactions, and that allows us to also do a lot of trend data on pretty granular level, not just looking at MSAs or zip codes, but we look at neighborhood block groups, census tracts, even custom radius searches for trends in rents and trends in values. And the next one is also, well, it's a little further down. I'll jump ahead to the yields. So the fourth part here, we not only have the rental AVM, but we also have a price AVM. So we've done for this universe of 15 million rental properties, we've gone back in time and estimated a value each month since the middle of 2012 and a rent for each property since the middle of 2012. And then we take 12 times the rent and estimated rent and divide by the estimated price, and we get an estimate of what the gross yield on the properties are. So it's a very valuable long-term time series, and we'll see some of that data shown graphically in a little bit. And those are coming from these rental price indexes and hedonic price indexes that are generated from those AVMs. So besides using them to calculate the yields, we can just look at the time series for each of them separately. And it's not a repeat sales index, it's not a median price index, but it's a hedonic-based index is a pretty good measure of price movements over time. That can be very granular, again, because it's property level. We can get down to the neighborhood group or block groups and do some interesting analysis on that. Can't really hold these down. Okay, so now briefly we'll segue to between what Sandeep talked about, the investment thesis, and it's at a higher level, basically like why invest in single-family real estate at all, and what were these companies looking at in 2012 when most of them started to buy and raise the private equity funds. And so, as Sandeep mentioned, that the income yields are pretty attractive, even with some compression now. Looking at high-grade corporates are yielding in the low 5%, and with arguably probably more risk because they're single names, so it's a discrete risk. Either the company pays the debt or it doesn't. Whereas in the single-family market, these bonds are backed by thousands of houses, so it's default risks are much more spread out, and so making it a lower volatility risk. And potentially, since you're doing the investment with equity rather than debt, it's a very long duration asset. So for insurance companies and pension funds who, the long duration assets now are 30-year treasury, yielding under 3%. This is a very long duration asset that's yielding, potentially twice as much as you're getting on the government bonds. Finally, the inflation hedge as from rent or price appreciation. And I think there's some, as we'll see some of the slides, let's talk about future price appreciation and spread compression that'll yield to give even higher total rates of return. So here's this one. I should have made this one line a little different. This is actually the rental price index, this heavy blue line that's smoother. The squiggly line is the overall CPI, and the green line is the FHFA price index. So you can see in general, the rents are less volatile than prices, and you can make a case that there's somewhat of a lead lag relationship there as well over time. And then the final piece on the investment thesis, you basically in the single family sector, you can get the returns of the stock market with volatility that's less than the bond market. So by implication, that means if you add single family houses, rentals to a stock or bond market, you're going to get higher returns and lower volatilities, which is what you're seeing here. That's adding 10% rental houses, that's adding 20% rental houses, declining volatility and increasing returns. Okay, and then I hope this doesn't. Oh, point. Okay, point doesn't point. Help the point there. Okay, Calvin. I hope this doesn't take too much away from your talk about REITs, but I did put a talk about the REIT sectors. The single-family REITs have been too new to really have much of a track record, so I used apartment REITs here as a proxy. Circle there, and you can see that it's right on the left side there, which is the highest return and the lowest volatility, only outdone by the public storage sector. So again, from a macro context of alternative investments, it's pretty attractive. Okay, now let's start to switch a little bit to more the property-specific and single-family specific sectors. And Sandeep was talking a bit about the breakup between appreciation and yields. So on the left-hand side, this is a 3-year average from 2013 to 2016. You can see that price changes, the green bars, sort of dominated, in most markets, dominated the total return. They're a bigger part of the total return. But in the last year, as price increases have slowed down in a lot of markets, now yield is a much more important component. And I think that's probably going to be true going forward, even with an average of 2 or 3% price appreciation. Yields are much higher than that, so it's that relative trade-off and balance is likely to continue. So, question, why hasn't more capital flowed into the sector? And $35 billion is a pretty big number in a short amount of time, but compared to the total, it's really tiny, as Sandeep said. So one thing is that there's only a handful of available investments, meaning of the public firms through consolidation now, there's only 3, basically. There may be some more waiting in the wings to go public, but there just really aren't a lot of vehicles. Private equity firms are still out there, and there may be some more, again, coming in the wings or getting to be bigger, but there's limited funds of people who can invest in private equity firms. And so far, the dividend yields have not been what people think about typically when they think about a real estate REIT. Apartment REITs are yielding 3.3, 3.5%. The single family yields right now are yielding between 2 and 2.5. So in a sector that you could argue should be yielding higher, it's actually lower on a continuing yield basis. Still relatively new sector, and it's still relatively small. So that's constraining some of the growth. This is putting some numbers on around the sector of how it's comprised. The orange on the left is the total, the number of investors divided by the size of their portfolio. And the orange share is for those people who own only one or two properties. So you can see that's over 80% of the properties of the investors only own one or two properties. And even adjusting by the number of properties, they own 60% of the number of properties. So very, very fractured industry. So when there's going to be some more professionalization or more growth among the REIT class, institutional class, it's going to have to come from, these kind of, small slices up there, which are this slice here is 11 to 25 properties. That's 6% of all properties. The next one is 26 to 50, which is only 2.6. And by the time you get to the top here of more than 1,000, it's only 1.2%. So to get this kind of consolidation that would look like the multifamily sector, you're going to have to reach down pretty far into these to find vehicles that consolidate these smaller portfolios to get a lot of growth. And right now, there's not a good vehicle for that. A little over 15 million, about 15.8. That's a statistic we get asked a lot, and how we benchmark that. And it's really hard because it said Census has a very small survey. So ours comes from public, and as Sandeep mentioned, especially for the institutional class, they record in a lot of different LLC names, so it's somewhat difficult to tag them. We've both done as good a job as we can to try and identify those and consolidate properties and ownership.
Just to clarify, so that 15.8 is for the number of properties.
Yes.
What about number of investors? How many?
It's a little over 10 million. So it's way to that. So the average is, a little over 1.5, about 1.5. Yeah. So a lot of those investors are getting their financing from Fannie Mae or Freddie Mac, up to 4 properties or 10 properties. The medium-sized ones are getting probably a lot of, community bank financing, or some of the newer companies, specialty companies like BDR or Colony Financing. Well, it's, they changed the name now. I forget what they've changed the name to. Yeah. So again, to show a different view of how small the slice is of the big investors, the chart on the right shows how many are plots of zip codes with the average value of the house in the zip code and the average gross yield in the zip code, and to get to 50% of their portfolio. So it takes only 205 zip codes to account for half of the public portfolios, in just 205 zip codes. And you can see compared to the total range of zip codes, that's over 2,000 zip codes to do 50% in the total rental universe. And not only just the number of zip codes, but you sort of positionally, you can see where the density is here. It's right around $200,000 and a 10%, well, actually someone less than a 10% gross yield. And the bulk here is, is actually by properties, it's about 150 and a yield more like 12%. So everything's skewed to the left. Here's another version of seeing that kind of skewness. The line in each of those 4 charts is represent for the top publics. So different measures showing the same thing, whether it's by where their yields are, the size of the property in square feet, by the property age, or the estimated current value. What kinds of properties that the big institutional guys are buying are very different from the rest of the rental universe. And to some extent, in some cases, that is going to provide some, if they stay in that buy box, it's going to provide some limits to growth as to how big they can get. Another quick look at that. This is by which MSAs, 20 top MSAs for the public guys. And except for the big bars, orange one is American Homes for Rent. Those 20 MSAs account for 90% of all the properties they own. And going down to the next 6, which are still large but much smaller. The blue bars represent some new cities that the bigger guys aren't in, but it's still still only 20 cities, but a little more diverse there in that size of the bars, like 25% of their portfolios are in other places. And so this is part of the measurement from the time series we have of yields, what happened to yields and the effect of price changes over the last 4 years. So the green dashed bar represents the average gross yield for an MSA, and then the blue line is in 2013, and the blue line is 2017. So you can see in almost every area, yields have come down, in some cases very, very dramatically. So facing that kind of compression and dropping in yields are some strategies that people can do to offset that, or where some of the potential growth for either new entrants in the sector are going to come from, or if the publics try to diversify a little bit and get away from their narrow buy box. So they can try and do some organic growth. They can do some, we talked about some smaller bulk acquisitions and consolidate up from the people who have, say, between 25 and a couple hundred properties. But perhaps more interesting is going to different submarkets in the areas they're in, or going into smaller adjacent geographic markets. One way to look at what this chart represents is taking the entire country and breaking it into 10 groups by price and yield. And the grades are somewhat arbitrarily just according to the deciles, but in commercial properties and other kind of commercial real estate grading, properties are quite common. So this is my first pass to get at property grading. And so you can see as prices go up and the grade gets better, the yields go down. Maybe those are in areas where the price appreciation potential is better. Maybe not. We'll see another slide or two. This is a snapshot. Yeah, this is a snapshot from earlier this year. Oh, sorry, yes. He asked what the time period is for this, so it's a snapshot, a recent snapshot. Yeah, so if you looked at the chart from like 4 years ago, it would be shifted up and to the left from 4 years ago. A lot of numbers here. This is looking at the same idea inside a single market of Atlanta. Again, breaking it into different tiers. I'm going to just skip over that because I've got it graphically in the next one. So the blue line here is the change in value over the last 5 years. Green line is the change in rents. And in Atlanta, as you went down the grade, meaning down in price also, had more price appreciation, less rent appreciation. Put those two together and you get a yield curve, different kind of yield curve for capital markets, not treasury yield curve, but in rents that compressed a lot on the lower quality end of the curve. So in terms of what could happen in the future, if those kind of trends occur in terms of having a little better price growth among the lower price tiers, you could see this green line would tend to flatten out even more. And that's kind of what I think would happen not only in Atlanta by different price grades, but also looking across metropolitan areas to, say, Augusta, Georgia, or Charleston, South Carolina, or Montgomery, Alabama, cities that kind of ring Atlanta and have some of the same macro characteristics, but smaller markets with higher yields. And that is it. Thanks.
All right, thank you. My role here as cleanup is to provide some perspective on the market, and I want to thank Sandeep and Douglas for giving a nice introduction to where the market is right now. Also thanking Laurie for inviting me here. My challenge is, instead of 25 minutes, I only have 10 minutes to give you the whole perspective. So I'm only going to address two questions. How did the market get to where it is right now, and where do we go from here? How did the market get to where it is right now, it's important to remember that there have been single-family rentals for as long as people moved on to get a second home. I have a chart here showing data just from 2005. There had been about 11 million single-family rental homes prior to the financial crisis. If you went a decade earlier, it would have been 10 million. So there's been a long history of people buying a home, they move up to another one, and they keep this one as a rental unit. During the financial crisis, there was a fairly large increase. This doesn't look like a huge increase because of the scale here, so the next chart looks at it in percentage terms of the percent change of single-family renter, single-family owner, multifamily renter, and multifamily owner. That is all different possibilities of structure type and ownership type. And over the couple-year period, the number of single-family rental homes increased by 3.5 million, which is a 30% increase, which is a huge increase. This is a direct result of the financial crisis causing financial stress, particularly in certain communities. When I first started researching the single-family rental market, the biggest question 4 years ago was, is this a trade or is this a business? And I think the presentation by my two colleagues here says this is very clearly a business. It's a business opportunity. And when I first started looking at it, one of the questions was, is it really important? Right now, the institutional investors own about 200,000 homes out of 15 million, which seems like it's not really that important. But the concentration of the homes really matters. Sandeep brought up Phoenix. Phoenix is where there were a lot of home purchases in the early years. Phoenix is a small to mid-sized city, and from 2007 to 2010, the number of single-family owner-occupied homes fell by 30,000, which is a large number for a city the size of Phoenix. The institutional investors bought 20,000 of those homes. So if we stop and think again for a second, there had always been single-family rentals, but a lot of them were by mom and pop investors, people who had their starter home and they held on to it, or maybe they bought one or two investment properties, something in the neighborhood, and they managed it in their free time. To buy those 20,000 homes required $3.5 to $4 billion of capital and some management expertise that was well beyond what the local people could do in their free time. So really, it was the combination of large numbers of homeowners who were moving out of ownership into rental that gave rise to the need for an institutionally managed, institutionally operated home rental business. So you can see here over the decade since the onset of the crisis, the single-family owner rose quite a bit. The green lines, these are condos. It's only 3% of the housing stock, so this is from the data from the ACS. They bounce around a bit. I wouldn't pay too much attention to the jump here. This is probably some sampling error. Single-family owner homes, owner-occupied, were little changed with actually slight declines over the time period here. The multifamily renter had fairly large increases, but over this decade, the number of households, the increase in households in single-family rental units was greater than single-family rental or any of these other categories. So really, the rise of the institutional single-family rental business was because after the housing crisis, you had to transition several million homes and fund them and manage them. The increase in single-family rentals of 3.6 million at an average price of around $175,000 is over $630 billion. So this is something that required institutional capital to come into the market. Now, where are we going to go from here? A lot of this depends on the fact that there is still housing stress in the market. Another measure of housing stress, and actually this feeds into what Sandeep was saying about the prices still being fairly attractive. We have a housing shortage in this country. You look at the level of housing starts, we have not been building homes at anywhere near the rate that the country had been building them prior to the crisis. And at this point, house prices have risen largely because there really is not that much stock available. Another measure of housing stress is shared households, that is doubled up households where there's an additional adult age 18 or older other than the head of household or the partner or spouse of the household. And it increased from about 19 million prior to the financial crisis to 23, 24 million right now. Again, I'm going to switch and look at this in terms of percent increase. It's a 20% or so increase in the number of shared households. Now the green bars here are a subcategory of this. These are the adult children who are living with their parents. Adult children living with their parents have increased by 50% since prior to the crisis. Everyone's read stories about this. Everyone has anecdotes. This is a source of household stress that says there are a lot of people who are still looking for ways to economize on housing costs, looking for a place to live without necessarily being able to afford it. My colleague Lexi here pulled some data for me from ACS yesterday, looking at the age of the head of households in each of the different types of housing. Single-family owner, single-family rental, multifamily owner, multifamily renter. And I was actually a bit surprised that the youngest of all of them, I thought the youngest of all of them might have been apartments, multifamily renter. But actually, the age was youngest in the single-family rental. It was 43 years as opposed to 45 or 46 years for the multifamily rental. And that tells you a bit about the demographic of the people who are moving into these single-family rentals. A lot of them are people with children. They're younger families. They're younger families. When I speak with industry executives, they say they're looking for people with 1 to 2 children. They have a certain 60,000 to 80,000 typical income. They're looking for something with a suburban school, a single-family structure. In an earlier period, they probably would have been a typical first-time home buyer. But right now, with the different financial strains in the economy, there are a lot of households that either don't have a down payment, don't have a credit rating that will allow them to qualify for a mortgage, or maybe they're concerned about the risks of home ownership and are choosing not to buy. So people who 2 decades ago or a decade ago might have been a first-time home buyer are now choosing to be in a rental unit, a single-family rental property. Where do we go from, before I get to where do we go from here, I'm going to come back to this, that the existence of housing distress and financial strains is one reason why the single-family rental business, particularly the institutional single-family rental business, is probably going to be with us for quite a while. Here's just showing a little bit more detail on this. Again, single-family owner, they're about 60% of the housing stock. Only 7% of the single-family owner had a shared household, an additional adult living there. I'll get to the orange bar in a second. You look at the single-family renter, they're about 15% of the housing stock, but 20% of the single-family rentals have an additional adult living in the household. These are people who are looking for someone else to help pay the rent. Multifamily renter is another 25% or so of the housing stock, but not quite as much of the shared households. Now you look at how much of the increase in shared households from prior to the crisis to now went to each of these sectors. The largest group actually went to the single-family renter. So the conversion of formerly owner-occupied homes to single-family rental has taken in a lot of the overflow from the financial crisis. I'm going to talk a little bit about the Reits. The Reits are about 3/4 of the institutional investors. They own about 140,000, 150,000 homes. They've actually been quite successful. I'd say there are 3 phases of the business. When they first were starting out, they needed to get up to a minimum scale of the number of homes that they could own. Several thousand homes in a metro area, 10,000 or more overall to justify the fixed costs of what they were incurring. Then they wanted to make sure that they were controlling their costs, but lately they've been focusing more on increasing their rents. The first couple of years when they wanted to buy the homes and get them occupied, they weren't focused on driving rents so much. This is the growth of same-store net operating income, percent change over a year ago. It's been ranging from 8 to 10%. There's a very strong demand for these rental homes, which means they're able to increase their rents. This compares to 3.5 to 4% growth in same-store NOI for REITs overall. This is just operating performance measure. I saw I have 1 minute to talk about the rest, so I'm not going to address this except for they've been paying dividends and they've been earning money. I can have another 2 minutes. Aren't you lucky? I can go on and on. So where are we likely to go from here? One issue is that there's been a professionalization of the single-family rental business. If you wanted to move, if you were moving to a city 10 years ago and you needed to rent a home in the suburbs because you had 2 kids who were in school, you had to contact a realtor in every single neighborhood and go and visit them and go to see where you're going to find them. Now you can go on the web, you can do a search, you can find the house, the price, the neighborhood, everything you want, all online with professional management. This is making it a lot easier for someone moving into a city to find a place to rent. We're probably still going to have a lot of people who are under some financial strain, but need the single-family structure in the suburbs, and that's going to be a source of demand. And there are other people who may be postponing the first-time home ownership, are eventually going to be a buyer, but they may rent a home for 3 years, 5 years before they move out. In terms of investors, the single-family executives say, yes, it might well be that this business model runs its course. How would it run its course? If the demand for home ownership increases enough that people wanted to buy the homes instead of rent them, well, that means they want to buy the homes, and there's going to be more upward price movement. The single-family rental business is perfectly happy with the idea that people who want ownership instead of rental might buy them out at a premium at some point in the future. So I'm probably done with my time, but the broad perspective is that the institutional single-family home rentals are filling a need in the housing market that wasn't being met anywhere else as far as raising capital, providing management experience, and more professional search and management experience for someone who's looking for a rental home. And I think that's my time, and I'll have questions later.
Well, thank you all very much for 3 really, really excellent presentations. I'd like to invite the panel to come up to the stage, and we'll begin our question and answer part of the presentation. Online viewers can submit questions to events@urban.org, and for both online and in the room, please identify your name and company. And if you're in the room, we've got mics that are being passed around. Just a 3-second commercial. Our next event is our 5th annual housing symposium with CoreLogic, entitled Housing Finance, Affordability, and Supply in the Digital Age. It'll take place on November 1st, and you can find additional details and register for the free conference at www.urban.org on our events page. So please, if you haven't registered for this conference, please do. With that, let me open it up for questions. And actually, I am going to, before I do, I've got one question in my hand, but before that, I'm going to actually, one question you always get in this market that everyone's very curious about is how much scope is there for growth? That is, Doug and Sandeep both presented broadly consistent numbers that show that the single-family sector of the market is around 1.2% of the rental market. How much do you think it can grow? That is, can it become 5% of the market in 5 years? And it obviously depends on a lot of things, but why don't we just sort of go down the aisle and get your view on sort of what's your view on how much it grows over the next 5 years?
So I think the trade or the business, when you look at single-family rentals, really consisted of 2 parts. So one is you go out and buy cheap homes and prices go up and you make a lot of money, and some of the operators really went out with that particular strategy in mind. And then the second part of that return equation really was buying these properties, managing them operationally, and create them into something which gives you a lot of return over the years. I think people have followed both the different strategies. We went from nowhere to about 1.5 to 2% right now. It's hard for me to see if the number goes up dramatically, but I think 5%, I think in a few years, is something that is completely possible. A lot of it will depend on how well the single family operators manage these properties, because the reality is it is operationally very, very intensive. So if they do a good job, I see absolutely no reason why single family rentals will not be a much bigger part of the market, much in the same vein as multifamily. But again, at 5% maybe, I think over the next 5 to 7 years.
Yeah, I think the issue isn't so much the operationals side of it. They've proven they can do that, but it's where the supply is going to come from. They had a sort of the perfect storm back in the aftermath of the financial crisis of the higher rates of foreclosure and short sales that really made a lot of inventory available in a short amount of time. Now, all the stories are going out that there's not a lot of inventory available for home buyers who arguably have a better bid than rental operators for the kind of houses at least the public guys are facing. So I think what's it's going to take is the willingness to extend down into other markets, whether it's by the existing players in the market or probably more likely new entrants by insurance companies, pension funds who have a different view, with Freddie Mac potentially encouraging affordable investments, with their kind of lending program to landlords. I think it's going to push that down to make these middle markets more attractive and maybe some lower markets more attractive. And that'll be, I think, what it'll take to get the much bigger numbers.
I'd agree you're probably going to see much slower growth, and I was actually going to raise the point that the really fast growth was during the foreclosure crisis when you had millions of homes that were being auctioned off. That's where most of the institutional properties were purchased, as well as a lot of the other smaller operators. There's another factor, though, the past 2 years or so that had weighed on the market, and that was the cost of capital for the institutional investors. So the REITs are publicly traded firms. They have publicly traded equities, and their stock price is their cost of capital. And if the stock price is low, it's expensive for them to expand. There was a period from 2013 through 2015 where the market wasn't sure if they would be able to control their costs. The biggest concern was how much is it going to cost you when you turn over a rental and you have to go in and you have to rehab it and everything. They've actually been quite good at controlling their costs. So last year, the stock price, the total return on the single-family REITs was 27%, and it's up another 16% this year. So you've had over 40% gain, which essentially means their cost of capital has fallen an awful lot. That makes it a lot more attractive for the larger institutional single-family rentals, the REITs, to raise equity capital and go out, whether it's consolidating from the smaller operators, whether they're buying from multi-listing services, which they've discussed doing, and there's also some discussion that they might do build to rent, although we haven't seen any activity there.
A little bit.
Thank you.
To speak of.
I have a question that came in online. While institutional investors are still very small, their share has grown considerably. What's the impact of this on wealth building for the middle class? In particular, this has two pieces. First, institutional owners may not cause a decline in home ownership. However, by keeping these homes off the market, they exacerbate inventory problems, resulting in price gains. This in turn makes home ownership, especially for lower income households on the margin of home ownership, more difficult. Do you agree with this statement, and what is the impact on wealth building opportunity? So number one is, what's the impact on driving up prices and therefore making it harder for potential homeowners? And second, are institutional investors pushing mom and pop investors who basically rent out a few neighborhood homes harder for them to build wealth? So are you pushing out mom and pop investors? So those are sort of the two questions. Calvin?
It's interesting how much the questions have turned. In 2012, the biggest question is there are all these foreclosures and the depressing home prices by 20% or more. What are we going to do with the impact of foreclosures and abandoned homes on these neighborhoods? The institutional investors came in, bought the homes, fixed them up, and rented them out, so they improved household wealth of every other homeowner in that area. As far as the opportunity for someone who may have previously owned a home to build home equity there, well, they'll need to save their money for the down payment. The institutional investors own 144,000 homes out of 100 million homes in the country. They don't have a stranglehold on the market. And the final one, what's the impact on the moms and pops, the people who own 2 or 3 neighborhood homes? They may have an opportunity to sell out to an institutional investor at a 10% premium. I think that's a good way for them to build wealth. So I don't think it's inconsistent at all for these players to be in the market managing these homes, and they buy and sell at market prices.
Yeah, it's kind of a zero-sum game. I mean, the people needed a place, the people who lost their homes in foreclosure needed a place to live, and so if they can't own a home, they have to rent one. That's like tautology. And of the 5 million homes that were increase in rental homes over the year, 4.8 million were bought by definition, smaller non-institutional investors. So at the average of 1.5 houses apiece, that's like 3 million people who bought houses and had the chance to increase wealth by owning rental property. So I don't see any merit really in the argument behind that question. So.
I mostly agree with, I think, what Calvin and Doug said. I think, and the answer really lies in the size of the market. Just to give you some numbers, if you look at Atlanta, which is one of the largest places, one of the places where institutions have really bought a lot of homes, even there today versus the housing stock, their share of holdings is less than 2%. In all of the sales that happened in Atlanta last year, they were less than 3% of all the purchases, which essentially means that if there are 100 homes on the block, about 97 were bought by other people. Even if you believe that 70 or 75 or 80 of those homes were bought by owner-occupied people, essentially mom and pop investors were buying the very vast majority of investor properties. So again, I think it's possible. I think you can always end up with a specific neighborhood or a locality where institutions have 15, 20, 25% share, and there would be sporadic issues, I think, once in a while. But to generalize and say that institutions are really crowding out retail buyers, especially given the sizes and the numbers, I think it's really, really a big stretch in my opinion.
And let me just take that one step further. You could make the argument that because some of the ownership, a big part of the ownership is done by Reits, that's opening up share to people to buy shares of Reits with as little as a few $100s in their IRA or a brokerage account. So
Thank you for stepping into my role in this job.
well, it'd be shameless promotion, self-promotion if you did that yourself.
Question over here. Microphone's coming.
Hi, my name is Prashant Kothari. So, the returns have been great and, the growth has been spectacular, but I'm just trying to figure out, extrapolate out 5-7 years out, right? The thing is, Sandeep, you spoke about the market growing potentially from 1.5% to 5%. But the thing is, what's happened so far has been, there's been economies of scale in the acquisition, right? Because they've been able to buy these large chunks. And two, there's also economies of scale on an operational perspective, because a lot of them are clustered together. If going forward, I think both are unlikely to be the case. So what does that portend for future returns?
So again, I think you've made, 2 points. So one, when I said that the share of institutions could go all the way to 5%, a lot of it depends on how well they manage things operationally, how they can go into a new market and start buying homes. I don't have a lot of color on each and every entity that operates out there, but I do know that more than one entity now has a very solid setup where they can go and start buying homes directly from MLS. I think they're buying 70, 80, 90% of their homes through MLS. I think it's certainly possible to do that. Now, for someone to go from 1.5% to 5%, I think it's going to be a factor of a lot of things. As I said, I think operationally, but if you look at just pure returns, a A lot of these homes are still trading at 5.5%, 6% cap rate, which essentially means that if you just buy them and home prices don't go up, you still have a 5%, 5.5% return on those homes. To the extent that home prices go up another 3%, your unlevered return is close to 8%. And with leverage, the kind of financing options that you still have out there, I think return on equity of anywhere from 13 to 15, 16% is absolutely not out of question. I would not be surprised if there are a lot of these players who start moving into newer and newer areas from what we have seen right now in the list that most of us talked about. And also, I think the build to rent is something which is relatively new. But again, I would not be surprised if you see a lot of development out there. So again, I'm not saying that we will reach 5% market share for institutions in the next 5 to 7 years. But depending on how things go, I think it is certainly a possibility. Even if they go from 1.5% to 3%, it is still going to be a very, very big leap forward, because they'll go from owning a few 100,000 homes to almost 500,000 homes.
I just add, when I've spoken with industry executives, their early stages, they hired people from the airline industry, from hotel and hospitality, so that they could put in systems where they could have one call response to any homeowner request, so that you didn't have to call the landlord, call the plumber, all of that. And they put those systems in so they're completely scalable, with the idea that they can double the size of it. They have the system there, they just need to hire some more operators. They set this up so that they could grow fairly rapidly if they want to. I think the biggest question is going to be, now that Invitation Homes has become a public company and they're completing these acquisitions and their share price is fairly attractive for further equity raise, how aggressive is their acquisition activity going to be? And we don't know how that is yet. That's, whether it's consolidation of previous portfolios, MLS purchases, or whatever, that's a big wild card.
Let's see, let's do Jim over here, and then Karan in the back.
Yeah, hi, I'm Jim Vittorello with GAO. To what extent, if any, have been the FHA and GSE loan sales, the distressed loan sales of the last 5-6 years, a source of any of these rental housing? Do you have any idea?
Yeah, it's for some it's been substantial. Goldman, for example, Goldman Sachs is well publicized for having bought a lot of the Fannie Mae and NPLs in particular. They've currently, their inventory of homes they've owned that they've had to take through the foreclosure process is about 1,200 or 1,500. But their preferred strategy in buying non-performing loans is not to own the real estate through foreclosures. They're trying to do workouts and get the mortgage performing again. So I don't think that's going to be a significant source, in a short amount of time. That said, though, I think the last numbers I saw combined, Freddie and Fannie have something like $200 billion of non-performing assets. So if only a couple of percentage of those were to find their way through to REO, would be a sizable number. Right, but then the only way they become investor property, though, is for that investor to have to foreclose on the property and convert it to REO. And they really try to avoid doing that because they're going to get a better outcome from modifying the mortgage or getting to be reperforming.
I think in general, I think if you looked at what happened in 2009, 2010, the yields that some of these loans were trading at was very high. So if some of these loans were trading at 15% or 20% yields, it made a lot of sense for people buying those homes to really push them through foreclosure. Because if you got your money 2 years sooner or 3 years sooner, given the rate of discounting that people were using, it would really change your returns in a meaningful way. But given where returns are and the kind of money that you can earn on some of these things, in general, it's a much better outcome to try and work out those loans, work with the borrowers. And I think you should see fewer and fewer foreclosures, A, because there is more incentive to modify, and B, home prices have also gone up. So I don't think it's going to be a big source. I think most of most of the institutional purchases will most likely come through one-on-one buyers on MLS.
Karan, and then
Hi, Karan Kaul here at the Urban Institute. My question is on financing of these deals. We've seen Fannie Mae came to the market a few months ago and did the invitation deal. Freddie is apparently going to come out with something, in the coming future. You also mentioned, Sandeep, in your presentation that there is other sources of purely private financing available in the market at fairly attractive rates. So my question is, how critical is GSE financing going to be for institutional players in the future? How dependent are they on this type of financing?
Okay, yeah. Sorry, I think it's hard to say whether it's going to be critical or not. I mean, the reality is that there was no GSE financing available for portfolios of single-family properties, and the market still came from nowhere to where it is. At the same time, if you look at the different financing avenues, you have warehouse lines, you have private label securitizations, and you potentially have the possibility of some of these institutions accessing the unsecured corporate market. To the extent that they have IG rating, they can get attractive rates. So there are really, I think, only 3 financing avenues away from GSEs. If you add one other avenue, which is most likely also going to be available, I think, even in worse times, it absolutely cannot hurt. I think, in my opinion, it's definitely going to help the single-family market a great deal, I think, if GSEs come into the play. And I think the related issue, which I think a lot of people don't talk about, is, so I think GSEs, I think I mentioned this during my presentation as well, that GSEs have almost always been making loans to single borrowers, I think, who are buying properties or investing in properties. They've also almost always had a program to do exactly the same thing on the multifamily side, where someone is financing 100 properties or 200 properties at the same time. And logically, I think it has never made sense logically made sense to me as to why they would not go out and finance a portfolio of single-family properties, because they're doing one property on this side, they're doing portfolio of multifamily properties. And especially given that the risk is actually lower on the single-family side, and I'm happy to share some more research. I think it just makes sense for them to do and be active in this particular space.
okay, question, young lady in the back.
Hi, my name is Pratima Damani from SP Group, and my question is actually a follow-on to the discussion about the GSE investments in this sector. We've been hearing about GSE's role, and with the added criteria of affordability entering into the single-family rental investments. I would like to hear from the panel what they think about what implications it may have for the rest of the investor community as GSEs start becoming more active, requiring more affordable investments or affordable rents to be put in place. Would it be more geographically segmented, you think, or is it going to impact, it's granted it's only 2% of the market, but would it have an impact?
No, I think the bigger impact is going to come not from the top institutional class, but the middle market who own more properties and they can finance through Fannie or Freddie's single-family program, which is a limit of 10 for Fannie and 4 for Freddie. Or going to the community banks or the specialty lenders and paying higher rates. So they're definitely going to be getting lower rates through Freddie Mac. So that's going to encourage some greater investment in that sector of affordable housing. But it'll be rental housing, not purchase housing. So I think it's making it a little bit more neutral with respect to home ownership versus renting.
For the REITs that own about 3/4 of the institutional single-family rentals, I would just stress they have a wide diversity of different funding sources. First of all, they have equity capital, which is going to be a very solid, safe form of capital for them to raise on their balance sheet. They could get a mortgage, they could get something from the GSE. They, in the past, when equity financing was not attractive, they did the securitizations and were raising $500 million at a pop with those, securitizing the rental receipts. And also, as an investment-grade entity, there could be bond issuance. They have a very wide range of sources. The advantage of a public company is they can raise capital in many different sources if they have an attractive investment.
Yeah, and that's reiterates what I said. For them, it's just another tool, but for the middle market, they don't have access to
Yeah,
those other tools.
the REITs are different from the smaller players. It's a different set of
Yeah.
constraints.
I'll just add one very quick thing. So if you look at homes which are owned by people who are living in them, they generally tend to be higher home prices. If you look at the distribution of all the rental properties versus owner-occupied properties, rental properties in general will fall towards the left-hand side. So I think even if they go out and focus on affordability, I think most of the homes that institutions have bought, I think away from the publics, I think they would most likely still qualify, especially I think the kind of homes that the mid-size and the smaller players are buying.
So with that, let me thank you all very much for coming. First, let's give our panelists and presenters a round of applause. This was terrific. Our next event is our annual Housing Symposium with CoreLogic, Housing, Finance, Affordability, and Supply in the Digital Age. Again, it's November 1st. Please sign up for it. Thanks again for coming, and hope to see you at an event in the near future.